Hello, everybody. John Lillywhite here. And for the next few minutes, I'm going to talk about something that I'm sure is going to create a little bit of controversy because I'm going to make a couple predictions. And the predictions are for people who are focused in buying a home this year sometime or refinancing sometime this year. It's going to be a little bit of an economics lesson, so I've got to be able to discuss some of the figures and some of the premise behind this so that I can make a prediction that I think can stick. Over the last 10 years or so, we've been in a kind of a comfortable mode in this country. And as during that time, the interest rates in pretty much everywhere have gone down, relaxed a little bit. I'm going to talk specifically about mortgage rates. They have gone down comfortably and reliably for the last 10 years with little jagged edges every once in a while. But I mean, in the last probably 4 to 5 years, we've seen interest rates that were in the fives and then the fours and then the threes. And experts like myself were thinking, how low can they go? This was just crazy, right? And so we knew that there needed to be a bottom of this somehow, but we didn't know exactly what it looked like. But it was probably 2 years ago, a year ago, that I predicted that something strange was going to happen here. When we got in the middle of the pandemic a couple years ago, the country, rightfully so, was spending boatloads of money. And when I say spending, I'm saying printing money, boatloads of it, trillions and trillions of dollars in order to protect this country from this pandemic. Rightfully so, I suppose, right? And then it was about a year ago that in addition to that and spending boatloads of money and printing boatloads of money, then we ended up getting ourselves involved in protecting Ukraine and their sovereignty and spending billions of dollars there. This is not money that's just kind of sitting around in tanks. This is money that needs to be printed. And when we print money like this on this grand scale, there's repercussions to this. And the repercussions to this is that it devalues what it is that you bring home. This is called inflation. And the only way that we can deal with inflation, is the Feds deal with inflation, is by increasing the prime lending rate. And this lending rate is what all the banks use in order to exchange dollars back and forth. And then there's a ripple effect. And that ripple effect is that it goes to our lending rates as well, credit cards, cars, and mortgage payments, which is what I'm going to talk about here. You are firsthand seeing what had happened on mortgage rates when you looked at what happened in the middle of last year. They were in the threes, and then they went into the fours, and they went into the fives, and there was this correlation between what was happening with the Fed lending rate and what was happening with mortgages. And that continues. Every time that the Feds increase the lending rate, it changes in an awkward and often indirect way your mortgage payment by an increased rate. And so there's always going to be this correlation. And the interest rates now, if there is a correlation, albeit kind of an unusual one, but it does exist, that as long as the prime lending rate is up, interest rates are going to be up as well. Now, they can go up and down a little bit, but you're not going to see this crazy thing where they're back into the threes and the fours as long as the prime lending rate is what it is today. So we need to ask ourselves, what is going to go on in this country with regards to our spending, and then with regards to what consequences that spending has and the choices that the Feds have in terms of increasing or decreasing the lending rate, because we are now in an inflationary situation, which is hugely dangerous, right? Because what the inflation does is it devalues what it is that you have in your pocket. Because everything gets more expensive because of all the spending that we did. You see, there's a consequence to all this stuff. We're seeing it now. So what's going to happen? The question is the country going to spend? And is it going to spend? How is it going to spend? And where's it going to get the money? We know for a fact, at least as it is right now, that we're going to spend heavily on things that have to do with protecting other people's countries. And I'm not saying that that's wrong or right. The fact is, it's going to happen. So there's more billions of dollars that are going out there. I'm sure that there's some ancillary pandemic spending that is still going on. But you know, the point is that we've spent multiple trillions of dollars in the last several years, which now has an effect on how much it costs for us to borrow as we try to impact and recede some of the inflationary issues that we see going on here. I don't believe that we're going to see a great deal of lack of spending that's going on in this country. In fact, I think that we're going to see that going up. If that spending goes up, the feds have they can't have any intention except to keep the prime lending rate where it is, and in fact, dangerously so, which I predict they're going to be forced to continue to increase these lending rates. We just got another announcement, the feds, that the inflation rate actually went up in January. And if that's the case, we have ourselves a problem because now the feds are going to end up increasing those Fed lending rates more, and that's going to have a direct impact on how much it costs for us to borrow. All right? So if we're going to continue that inflationary correction that the feds need to do by increasing their rates, guess what's going to happen to mortgage rates? They're going to go up. Now, I know that there are people who are predicting that they're going to go down, and no one would like to see that happen more. I really would like to see that happen. But the reality of it is, I see that there are some key economic indicators that's going to mean that that's going to continue to go up. I don't know how much it's going to go up, but I don't believe it's going to come down. So if you're going to buy a house in the next, let's say year and a half, if you wait because you think that interest rates are going to come down, I don't think that that's a good strategy. I think it's going to end up getting more and more expensive. All right. So even if house prices go down, the interest rates going up is going to offset that, and it's going to put you right back where you were before. Hopefully interest rates aren't going to go up much higher, but if they do, it's going to make it more and more expensive even if house prices come down. My point, if you're going to buy now. Don't try to overthink the fact that by holding off and not buying is going to be beneficial to you because interest rates are going to go down. You have to look at yourself in the bigger picture. Ask yourself what's going to happen in this country. Ask yourself whether that government spending and the consequence of the feds increasing their prime lending rates is going to somehow make it more difficult for you to buy. Watch these factors, and if you've got any questions whatsoever, positive or negative, whether you agree with me or not, I'd sure love to hear from you. And we can kind of talk those things over. I'm always around for you. Thanks again. Look forward to talking to you soon. Bye-bye.